Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to go through the Primary Vision Frac Spread Count and then just some color around what is happening in the world today. We've had some news come out that is coming out of China in terms of oil demand, what's happening with the virus and the movement of the vaccine, as we keep talking about the logistics and a lot of the issues that are arising or we expect to arise that we go through in the economy show and the EIA show. So before we get into it, we please like to remind you, like, share, subscribe. Your support is appreciated. Any comments you have are always welcome. So here we are. Just to be clear, we thought we were going to get to over 160 by the end of this month, and so far the count increased by 15, going from 143 to 158. So we're getting there. We're getting close. We're almost at that, over that 160 mark. The biggest increases came from the Permian, which isn't really surprising based on everything that we've been talking about. It's at the top of the range that we outlined in our report that came out last Friday. It's we think it's going to continue to grind higher, but this is kind of that big snapback, and now all of the new additions are going to take a little bit more time coming across. The Haynesville had some activity. Denver is one that we think is going to kind of stay within this range that it currently is now. And these are things, again, that we went through in our the report that came out on January 8th. And so far, we're pretty much holding within that range that we've highlighted. But again, it's just going to be a matter of how quickly can we snap back. And just when you look at what is happening in the curve, it makes sense. And if we go through some of the different components of that, which we will, we're going to get some support on why we're going to see activity really cross that threshold. So when we look back, obviously, we typically have a recovery. So it's very important to appreciate that we typically see that dip that happens mid-December, and then people go on vacation, they take their time off for Christmas, New Year's, and then we start to get back to work, and we're already seeing that. The difference is we think it's just going to continue to grind higher. So now that we have all of that work coming back that went away for the holiday, a lot of these are going to be new additions, not just equipment that's already in the on site, going home, coming right back, starting back up. This is going to take a little bit longer. But when we think about a little bit longer, you can see it's been a very gradual move up. And here you can see we're back to, on December 11th, we had that 159, right back to 158. Again, taking back that dip that we saw going into the holiday. We had that first snapback, now the second. And now, as we go forward, 165 to 170 is very much in play here. And again, we're getting closer and closer to what we need to see with 130, 140 oil spreads to keep production flat. We expected to be at about 10.7 to 10.9 into the exit. We're going to be right at that 10.9 as we head into the starting 2021. But we do have fresh budgets. We have a renewed push to capitalize on the market. And how are we capitalizing on the market? Well, let's look at the crude curve. This is one of the reasons why Russia was pretty adamant with Saudi Arabia of not doing that large cut, because you can see the shifts that we had across the board. So the orange line is the curve from today that we snapped about an hour ago before we started filming. And the green line is from 3 days ago. So you can see we're still waffling within that range, but it's more important to think further down the curve. So you can still hedge above 50, again, not including costs. This is just, straight up, you can hedge above 50 going into January 2021. Now, once you factor in prices and obviously, you're buying puts or swaps, whether you're going to do a put spread, a collar, that's going to adjust your cost. But we have the ability to do it, which again is going to open up some of that protection, where if you can hedge above that 50 number, and again, not that 50 is a magic number because nobody's getting rich off of that. It's just a matter of how can you manage your cost. Can you manage your debt at these levels? And that's why this cash flow is so important, especially to lock in. But even while we have obviously these front months surging, the difference right now is we have the Brent prompt time spread, which is March, April at this point, is back into contango. It's negative 2 cents. Again, it's going to waffle back and forth between this area, and it's really driven based on China disappointed, as we said they were going to in December imports. As we were highlighting that we had a huge, continuation of price strength in the physical market from November into December. Then we had a pretty steep drop off that really started to kick off in December 12th. And then we saw that accelerate in the first week of January with Angola cutting prices. So far, they're slow to sell February. And West Africa is typically the first that announces, and just based on the grade of crude that they create or that they produce, really is going to be a bellwether for how healthy is the market overall. Now, Angola, we pick on them for the most just because they sell about 60% of their crude into China, and the Chinese crude futures, actually, most of that is settled in Angolan crude, or at least a large part of it. So again, this gives you kind of that overarching theme of how is demand in Asia and what is that going to look like. And then so that's why we look at the regional aggregate indicators. So BNF puts this out. This is something that we cover a little differently using some different data sets in the EIA show. But again, we can see China rolling over, Europe bounce back, but it's always a matter of, are we getting to where we were pre-holiday? And here you can see that we're still struggling to get back to any sort of normalcy at this point, as we do have the lockdowns extending. China has, they have two areas that's impacting about 54 million people that are in some sort of lockdown. The problem is they're heading into Lunar New Year. And when in China, Lunar New Year is really the largest migration holiday within the Chinese calendar year. And that's why they've already canceled flights. They've already started to say that they're going to limit the amount of travel. And this will impact the amount of demand that they have. And especially just that's kind of setting ourselves up for some slow demand. You can see North America, rest of Asia, all of this continues to be fairly flat. The rest of Asia continues to be fairly a bit stronger as we look at Taiwan, Malaysia, Indonesia. South Korea and Japan are shifting down a bit, but again, there's getting some offset. Europe's the one that remains struggling, especially now that Pfizer announced, and we've been talking about how the logistics of getting a brand new vaccine that has to be so cold around the world, ramping the assembly line, trying to get it to where it is. It's going to take time. There's going to be hiccups, and we had another one where they cut the amount of doses that will be able to get there in the near term, but they're saying that they're going to be able to keep their quarterly target. Again, this is going to be a problem as we head into the new year. And then when we look at daily activity indicators, again, these are things where China's trending lower. We'll talk more about China and what does that mean as we next week in the economy show with some new data points and some new things that we've been finding. Advanced economies, again, emerging markets, we continue to see this inability to get back to where we were pre-holiday. Now, typically January is much slower, but again, we were starting from such a low base. The hope was that we were going to get to that snapback, and we're just not getting to those levels. But when we think about, okay, well, what does that mean for oil? Like clearly, this isn't this part of the of our offering is an oil offering, and well, what is the impact? And that's why when we look at the displacements of crude and what has that done, the U.S. increasing, obviously, our production, we're importing much less from West Africa. So as we import much less from West Africa, well, that means that it has to find a new home. And now Nigeria is competing more in Europe, and Urals actually had prices are back to up to a 1 month high, which is positive to see. But again, these are things that we talked about in the OPEC show, where we essentially said, look, if Saudi Arabia is cutting, Urals are going to benefit. So it's just a natural replacement. So when you have a million barrels coming out from Saudi, you're going to go and make up those barrels. And to us, Urals was just a natural beneficiary, and we've seen that come through. So again, this is going to come down to this market share, but this is where not only is U.S. crude going at a greater rate into other areas, especially when we look at Europe and Asia, because so far South Korea continues to be a fairly strong buyer. Europe is fairly stable. It's still going to be down year over year, but still going to be up month over month. So again, it's going to be supportive of U.S. exports. But at what level? And that's why we keep talking about that 2.8 to 3 million is where we feel comfortable, just given 900 to 950 about where we're going in different directions. So there will be support. But when we talk about China, and this is something that we were very adamant about, here we're seeing the Chinese preliminary import-export data. So Chinese crude imports fell to a 27-month low of about 9.1 million barrels a day. And that's the bigger issue, because what does that mean? Well, we're year over year, it's down about 15%. Month over month, it's down about 15%. So you had import quotas that were pretty much used up. That again also led to the different issues. But on the other side, not only were you importing less, but you were exporting more product month over month. So when we look at oil product exports at 5.9, it's still down year over year, which makes sense just given where the world sits right now in December. But when we look at it month over month, the exports were up 19%. So they imported 15% less crude, but exported 19% more product. Again, this is what we keep talking about when we have to look at, well, what is China going to do now that prices are going up? Well, they have a lot of crude in storage. They have the ability to try to manage this, and clearly there's enough product in there where they're trying to get in front of some of this product and pushing it into the market. But they're clearing some space. They're going to open up. So we do have an increase in VLCCs heading to China. We've talked about how imports will remain low into January, especially when we look at pricing, with Angola cutting prices, struggling to clear some of the barrels. We have cargo starting to pile up a bit in the Middle East. But the North Sea continues to move product into China. So again, it's this bifurcated market, but the net, we're going to continue to see China struggle, especially now with these outbreaks, with this slowdown in terms of internal demand, especially as we go into Lunar New Year and some of the slowing that we typically see in terms of an increase. Now, this is just kind of rounding out in terms of what we saw for the year. Crude imports, even though we had a weak December, it's still up 7% year over year when we look at the aggregate. But this makes sense because we have to consider that there is just more refining capacity coming online. They had more crude tank farms coming on. So again, those had to be filled. We had more capacity coming on. Exports were down 7%. So the crude imports were up 7%. Crude oil product exports were down 7.5%. We expect to see that flip, where we're going to see crude imports again remain strong in 2021. Now that we have new capacity coming on, that's going to import oil. But crude oil product exports will start to surprise to the upside, as we do see more going into the market, just given where the demand is locally versus internationally. And if we don't see those product exports, then we expect to see those crude imports starting to slow. But while all of this is happening on the demand side, well, we have Libya that is continuing to grind higher. Now, so far, everything is holding. They're supposed to have their elections in December, but this individual at the bottom, reporting Libya, highly recommend the follow. He's been fantastic in terms of showing what's going on. Been very much ahead of the news cycle. And when we look at what's happening, well, there are 4 wells being drilled in the Erawan oil field. There are 4 wells that are being tested on the first stage testing. Then there's going to be a quick follow-up as long as those results come back well. And then incremental progress continues in Libya's oil recovery across Waha, East Libya, and when the largest joint venture in the Sirte Basin. Again, these are things that we continue to see as they're rehabilitating these assets. General Haftar has come out very supportive of the rehabilitation effort. And because things were damaged, things were neglected, so there needs to push forward. And right now, the production is at about 1.28, which gives us confidence that they'll continue to be able to export at about 1.1 million right now. Then on the other side, because obviously we've talked about how Saudi Arabia cut their oil production, but we do have them starting to take crude deliveries into the Jazan refiner. Now, what does that mean? It's been shut since about 2019. Now they're starting to test it, bring it back on. And this is why we talked about you have to separate oil production, oil exports, and then water product exports. So if they're going to take their crude and instead of exporting it as crude, export it as product, that's not counted. But so even though they're taking 1 million off the water and on an oil side, it doesn't mean that they're taking all of it off when we start looking at exports from a oil side, but also from a product side. The refinery typically yields about 250,000 barrels of ultra low sulfur diesel and 80,000 barrels a day of gasoline. Again, it's just going to be a matter of, when does this start up? Is this going to be a process where they're looking to maybe export a little less crude over the longer term, more product? This is going to be something to watch as we continue to see these moving and differencing and trends. A quick update on China. We're going to go through this more next week. Again, back to the Chinese story. So Paaniq, they just got sanctioned by the U.S. government in terms of what they're doing. This is, again, that breakdown of what's happened in the South China Sea. The 9-dash line is obviously very important. The Spratly Islands, the Paracel Islands, they continue to be disputed. The bigger issue right now is Paaniq has pushed further into the territorial drilling for Vietnam and the Philippines, using these islands as a means of saying they're ours. And that is, again, pushing this a little bit further, which is why Vietnam continues to turn to other nations, specifically the U.S. and others, including India, in terms of finding ways to deal with the aggression of not only the Chinese military, but also their economic interests. Now, just to put it into context, the eastern South China Sea accounted for about 242,000 barrels a day of oil equivalent in 2019, which is 17% of their production. But they have found some different faults near Hong Kong, so that's where they're going to be drilling, which is in the China's territorial waters, which isn't a huge issue. It's where when they start pushing further and further down into that southern Chinese Sea that you get into what is the Philippines, what is Vietnam, and again, these are just continuing issues as we see more pressure. And based on the commentary we've already had from President-elect Biden, unlikely to see a lot of these changes in that or rollbacks, given that the pivot to Asia happened under the Obama administration. He was a very big part of it, and it's going to be difficult to see a lot of this adjust. So again, a lot of things happening in the world, a lot of movements, but long and short of it all is the U.S. is coming back strong. We have rig counts up about 12. We have frac spread counts up 15. Again, where the oil prices above 50 are going to bring some production back, and it's not even so much that it's going to come back and grow. It's just we're going to hold this line, and that's where I what is the long term? I would say that the long term U.S. production, based on what the world can handle, or at least wants, is something closer to 9.5, 10 million. But we are seeing more liquids demand, as we'll talk about again with LPG, as we'll talk next week when we look at naphtha and condensate in general. So the U.S. has a place, but again, what is oil? What is liquids? But 11 million barrels is definitely going to be something that we're going to hold at least through the first 6 months, and then depending on what hedges are laid out, how long that can hold. We're going to see a pretty sustainable run above that 160 number, and I think we're going to be able to hold that 130 to 140 oil spreads, really keeping production flat at these levels. So it'll be fun to watch. Hopefully you're enjoying our shows. If you have any comments, questions, things that you'd like to see us do, we will be coming out with the benefits of fracking. I know that we promised that last year, and unfortunately I fell behind. I'll catch up on that, I promise. So thanks again for watching. We hope you have a great weekend, and we'll talk to you next week. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.